Hey guys, Frank Curzio here with another live video, and the title of this video is here's how dangerous the market is. Uh, we've heard over the past few weeks of the greatest investors in the world. We heard Druckenmiller, we heard Tepper, we heard Singer, all billionaire successful investors say that this is the most dangerous market. Warren Buffett didn't really purchase anything, didn't purchase anything on the way down, which, that's his forte, that's what he looks to do. But you're hearing that a lot of how dangerous this market is. That doesn't mean it can't go up, is like we're seeing, right? We're seeing stocks go up, and even I'm getting lots of questions. But I just want to put some things in perspective for you, because there's a good report that just came out, and I'm going to share my screen here. And this is from Credit Suisse. So they came out with this report yesterday. I always want to give you research that's up to date. But they said small caps earnings per share expect to decline 95% in Q2. So essentially, they're going to have almost all their profits wiped out. And here's a pretty cool chart where they show where they're going to see the biggest declines in Russell 2000 compared to S&P 500, if you could see here. But healthcare with the biggest profit declines in Q2, along with cyclicals, tech, that's cyclicals, financials. Okay, that's cool. Now, why is that such a big deal? Because you're looking at Q2 estimates, you may say, well, that's the past. But you know what? I want to show you why this is important, because we're all anticipating that we're going to see bounce in earnings. But what happens if that's not the case, right? You always have to say what if, because right now we're priced not as we're going to go back to pre-coronavirus levels. We're priced as if we're going to have the best conditions in the history of all time markets. So I want to show you something else where I'm going to share my screen. And this is from my Capital IQ system. So this is a PE ratio, a forward PE of the Russell 2000. It's trading at 64 times forward earnings. That's year to date. Let's go out 3 years. Look where we are compared to 3 years. Let's go out 10 years. Let's go out to the max, which, since they've been keeping research, is 2,000. Look where we're trading on forward earnings, right? 64 times. Look at this number. What does that mean? It means that these companies better start earning money by next year. You're looking at this. These are based on 2020 estimates. You're seeing how expensive this market is. That's why it's very, very dangerous. We saw a market similar like this in 1998, 99. It started declining a little bit, and then what happened from 1999 to 2000 to the peak in the tech bubble? We saw the NASDAQ double. We can go up higher from here. There's a lot of positive news, a lot of stimulus, but at the end, numbers are going to matter. And if these companies do not put up earnings, which, again, this is signifying not that they're going to go back to pre-coronavirus levels, which we're not going to see those profits go back to those levels for at least 2 to 3 years. It's signifying that we're going to have the best conditions in the history of the United States. I'm not too sure I see that. So if you're buying stocks, especially small caps, be prepared and don't be surprised if these names fall 30, 35% in a couple of weeks, because that's how expensive they are. So just want to let you guys know about the risk reward, which is very important. That's what investing is all about. Frank Curzio, and I'll report back to you guys soon. Take care.